The waterfall structure in investment financing, particularly in private equity and hedge funds, is a complex mechanism for distributing profits generated from selling assets, exits. It ensures a predefined order for how cash flows are allocated among various stakeholders, balancing risk and reward. Here's a more in-depth explanation with examples. Structure and tiers. 1. Senior debt. This tier represents loans provided by banks or other lenders. They receive their principal amount, the original loan value, and interest payments first, acting as secured creditors with the highest claim on the assets. 2. Preferred return. This tier caters to investors. They receive a fixed percentage return on their investment, regardless of the overall profit generated. It's like a guaranteed minimum wage for their capital contribution. 3. Catch-up provision, optional. In some cases, a catch-up allows investors to recoup any missed preferred returns before moving on to the next tier. 4. Carried interest, carry. This is the tier for the fund manager. They receive a percentage of the profits remaining after all senior claims and preferred returns are paid. This incentivizes them to generate high returns as their bonus increases with better performance. Carry percentages can vary depending on the deal and the negotiation between the fund manager and investors. 5. Hurdle rate, optional. This hurdle sets a minimum performance benchmark for the overall investment. The fund manager might not receive carried interest until the returns exceed the hurdle rate. Example breakdown. Imagine a private equity fund invests $10 million in a company. The waterfall structure might be set up as follows. 1. Senior debt, $5 million loan from a bank with a 10% interest rate. 2. Preferred return. Investors get an 8% annual return on their $10 million investment. 3. Catch-up provision, optional. Let's say the investment didn't perform well in year 1, so investors didn't receive their 8% preferred return. A catch-up provision would allow them to recoup that missed return before moving on to carried interest. 4. Carried interest. The fund manager receives 20% of the profits remaining after senior debt. Preferred returns, including any catch-up, and any hurdle rate, if applicable, are paid out. Benefits and considerations. 1. Alignment of interests. The waterfall structure ensures everyone involved has aligned goals. 1. Investors get their money back first, then a guaranteed return before the fund manager benefits. 1. This motivates managers to outperform to access carried interest. 2. Transparency. A clearly defined waterfall provides transparency for all parties about how profits will be distributed. 3. Flexibility. The waterfall can be customized based on the specific deal and risk profile. Keep in mind, 1. The waterfall can get complex with additional tiers and calculations. 2. It's important for investors to carefully review and understand the waterfall structure before committing to a private equity or hedge fund investment. There might be legal and tax implications associated with the waterfall distribution. The waterfall effect is a cornerstone of private equity and hedge fund investment structures. Understanding its intricacies helps investors make informed decisions and ensures a fair distribution of profits based on risk and contribution.